started shortly. If you are a guest that registered before today, you likely have a seat up front, so please come up and look for your name card on the table.
Sorry. I know. I don't have access to it anymore, but I'll send Lee a note. I have to do it. Did you ever get that up on YouTube or anything? So we can get it on the road. Get it on the YouTube channel. I'll connect to her today. I'll make a point. I'll just shoot her and say, hey, can you get this up there? You should be slow on drop off. Story comes
Vice President of the Rotary Club of Louisville, and I've been asked to say, Paul Harris, 5+. All right, so providing our invocation today is going to be our recently reinstated member and a longtime dear friend of mine, David Graves. Now, many of you know David Graves was the former Executive Director of Home and the Innocents and also President and CEO of Brooklawn Child and Family Services. David?
Thank you. As we prepare to commemorate the life and work of Martin Luther King Jr. on Monday, I want us to reflect on the words of a prayer written by Marion Wright Edelman, the founder of the Children's Defense Fund. O God of great faithfulness, we confess that sometimes we feel like giving up. In a world where it seems poverty and violence will always be with us, our hope succumbs to despair. We confess that sometimes denial and distraction are less painful than vision and commitment. We confess that often we lose our vision, your vision, of a world where righteousness and peace embrace each other. We plod through our lives and don't dare to dream your dream of a world made new. O God of hope, renew in us your vision of a world made new. Mold our hearts and spirits that we might work together and listen for your word in the voices of our children. Remind us that our only certainty must be eagerness to do your will. Amen.
Amen.
All right, thank you, David. Now, at this time, I want to invite a wonderful friend of mine, someone whom we shared a position at different times together. Rotarians, I want to invite Kristen Boone, who is the former president and CEO. Did you just walk in the door? Oh, okay.
You're waiting.
Oh, in the wings. All right. Let me reintroduce to those of you who do not know Kristen, the former president and CEO of the Fund for the Arts, and more importantly, the new market director for PNC Institutional Asset Management Group. Kristen, you're going to lead us in the pledge and the four-way test.
All right, will you join me in the pledge?
I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
And in the four-way test.
Is it the truth? Is it fair
to all concerned? Will it build goodwill and better friendships? Will it be beneficial to all concerned?
All right, thank you, Kristen. All right, at this time, Rotarians, let's take a few moments and introduce our guests that are with us today. Make your way to the microphone. And guests, when you are introduced by your Rotarian host today, please stand. Fred?
Yes, Madam Vice President, my guest today is my dear wife, Linda. Linda's a retired attorney, community activist, past president of Goodwill Industries of Kentucky, and a present member of the board of Kentucky Waterways Alliance, which is one of Rotary's cohorts, as we all know. Thank you.
All right, Linda, where are you?
Vice President Erskine Courtney, my guest is my son, Will Courtney. He works in internet sales at Honda World.
Hello, I'm Sharon Rue, Executive Director for the Kentucky Foundation for Women, and I'm pleased to introduce my guest, Ms. Alice Holt, and she is the VP for Advancement at Kentucky College of Art and Design. Welcome.
Good afternoon, fellow Rotarians. Kevin Fields, Club Director and DEI Committee Chair. Pleased to introduce two guests today that are with me. Tiffany Williams. Tiffany is a director of the Louisville Central Community Center, so she's a board member of my organization. She's also the owner of Eternal Realty and the current president of NARAB, the National Association of Real Estate Brokers. So welcome, Tiffany. And also over here to my left, Aaron Kent. Aaron Kent just joined my staff a few months ago as a program manager for the city's Cure Violence Initiative. So we know that's a very sensitive issue that he's working, and I ask you to join him with support and encouragement. Thank you.
Good afternoon, Vice President Barbara. My name is Tony Hammond, and my guest is Patricia Cervera. She's a health empowerment coordinator with La Casita Center, And she also volunteers, helps with the Board of Health for Louisville, and co-chairs their immunization committee.
I'm short, sorry. Good afternoon, everyone. My name is Timothy Nicolazzi, and I'd like to introduce David Raley, who is my incredible coworker and friend. Does a great job, and I'm always excited to work with him. So thank you, David.
Good afternoon. My name is Louis Seeger. I'm a private banker with Republic Bank. My guest today is Alex Campbell. He's a senior private banker with Republic Bank.
Good afternoon, Vice President and Rotarians. My name is Alyssa Gray. I'm the President and CEO at the Kentucky Humane Society, and I am thrilled to introduce Savannah Menendez. She is our new development director, and she started as a volunteer at 16 and is now 10 years later in our leadership team. So very, very proud.
Hi, Barbara. My name is Roland Blahnik. I have brought my guest today, a friend, Bob Walker. Bob started life as a farmer and a banker, moved into residential real estate, and he's now semi-retired from the real estate business.
Good afternoon, everyone. Delene Taylor, Executive Director of the club. And I was telling Roland earlier, I really don't understand why every single member does not have a guest each week. And he said, you guys don't have that many friends. And I disagree. So I'm expecting you to register a guest for next week with Tammy York-Day. All right, I have a few guests here. Jonathan Rich-Tarsik is back again with us today. He is the bottling project manager for Sazerac and the principal for Rich-Tarsik Consulting. Welcome. We have Ryan Paxton, who is the VP of Commercial Banking for Fork Bank. Jamie Elliott. Is Jamie here today? There you are. Jamie is the Senior Major Gift Officer and Director of the Parent Council for Center College. Did I get that right? Awesome. Welcome. Herbert Johnson, did you make it here today? There you are. All right. You are a food and beverage consultant looking for your next adventure. Is that correct? Correct. All right. Welcome. We have James Allen, who is the Vice Chair of Baird. Welcome. We have Emily Chandler, who is the CEO of Leave It to E. We have Kenya Wade, who is a prospective member and CEO of Cycle Breakers Breaking Chains. Where's back there, Kenya? Did Charles make it here today? Yeah. Charles, where are you? Charles Robello. He is a friend of Walt's and a regional market president for First Financial Bank. Welcome. And last but not least, a dear friend of mine and former boss, B. Rosenberg, is here with DMLO CPAs. I don't think we mentioned Mike yet, but visiting back with us today is former member and treasurer Mike Richardson with GlenviewTrust Company. Who else is a guest, has not been mentioned yet? All right, thank you all for coming.
Well, for all of our guests, my script up here says that, and President Walt gave me this script, and I think he's trying to trip me up a little bit today. He said at this time, Barbara, just tell all the guests to join to your left Craig Sherman right after the meeting to hear about what is Rotary. And I took my glasses off, and I didn't recognize anyone over there that looks like Craig Sherman. No. So, John Bush is over there, Tracy Holliday is over there, and several others. Craig Sherman, are you in the room? You got to be kidding me. This must be the very first meeting Craig Sherman has missed. Ever. Guest, I'm just saying, let's put out an APB for Craig Sherman. He has never missed. Okay, you all are an amazing looking group. This is so much fun standing up here because I can literally see almost everyone in the room. Okay, Rotarians and guests. please welcome to the podium at this time to join me, our fellow Rotarian, Jay Mallory. Jay is the Executive VP of Marketing and Business Development for Image Quest. Jay is also a club director and co-chair of the Membership Development and Engagement Committee and Paul Harris Fellow. Yes, sir, thank you for that. Jay he was recruited at the last minute, I think at 4 minutes till 12 maybe. So Jay's going to do a great job pinning some of our newer members. Jay, you ready?
I'm ready. I need your script though.
Oh. Okay, there
You got more? There we go. Hey, by the way, you're pinning.
I'm pinning?
You're pinning.
Okay, I'm pinning. Here we go. Does that mean we're going steady? Okay, got it. Here we go.
You moved it Western.
Okay, yes.
Weren't you in love with the party?
I was. Who told him that? Oh my gosh, you were packing at the apple, right?
I was paying attention.
Okay, do you have the fire truck out in the parking lot? I don't. On with the show.
There we go. Would Chris Davis, Aaron Miller, and David Graves join me, please? There you go. So it's always a lot of fun to introduce new members to our club. So we're going to start with Chris Davis, my friend Chris. So Chris is the VP of Community Outreach for First Southern National Bank. He lives in Louisville with his wife and 3 children. And Chris has been in banking for over 10 years, specializing in small business banking for the majority of his career. In his recent outreach community role, he focused on building long-term relationships with the underserved community through working with business leaders, nonprofits, churches, and other influential organizations. He also does business development with a focus on real estate secured lending for small business and commercial clients. Chris is passionate about serving and is currently involved with a Rotary mentor program at Western. And I think he just got finished renovating a house. Are you finished? All right. Let's give Chris a warm welcome. So Aaron Miller. Aaron has been with the Leadership Louisville Center since 2011. Prior to joining the center, he spent 17 years in broadcasting, working as a radio morning show host. Really interesting. And promotions marketing director. He was elected to 2 terms as a city council member of the city of Linden in 2002 and 2004. And he currently sits on the boards of the Lincoln Heritage Council of the Boy Scouts of America, the Catholic Foundation of Louisville, and as a member of the Louisville Free Public Library Advisory Commission. So Aaron, what did you do on your morning show?
Mostly inappropriate things.
Got it. Would you like to take the mic? All right. Join me in welcoming Aaron to our club.
All right, I was going to officially pin Aaron, but we have locks on the pins. They will never come off the lapel once you can figure out how to get them off the piece of paper. All right, Aaron. Okay, see if you can do that before David gets his. And I'm working on mine.
So we need to add that to make the 5-way test. Get the. All right, and David's already been up here, but introduce David Graves. David grew up in Louisville, graduating from Atherton in 1962. After college, David served in the Peace Corps in Uruguay and then returned to Louisville to earn his master's degree in social work from the University of Louisville. His first position was the Commissioner of Children and Youth in Frankfurt. Later, David served as Executive Director of the Home of the Innocents for 12 years and as President CEO of Brooklawn Child and Family Services for 20 years. Upon retirement, David became a consultant to several nonprofits here in Kentucky. David and his wife Margaret have 2 sons and spend their summers on their son's farm in the Adirondack Mountains. So join me in welcoming David Graves. And it says, back to you, Vice President Barbara.
Okay, yes, okay. All right. Chris is looking in his pockets to see where I put the pin. Chris, it's up on that, the right lapel over there. Thank you. All right, Jay, thanks so much for stepping in and helping us with that. Okay, at this time, I would like to welcome Aju, are you coming with me, Rasterji, to come up, Corporate Counsel and Chief Fiduciary Officer at GlenviewTrust Company, to the podium, and he is going to introduce our speaker. It's all yours.
All right, thank you.
Anuj Rastogi. And I'm used to it, but I like Anuj. I'll go by either if you'd like. So I'm, as she had said, I'm the Chief Fiduciary Officer and Corporate Counsel at the GlenviewTrust Company, and I'm here and pleased to introduce my colleague and friend Bill Stone, who is our Chief Investment Officer at GlenviewTrust Company. Bill began his career at Solomon Brothers, and prior to that was the Global Chief Investment Strategist at PNC Bank. You may recognize him. I sometimes refer to him as Hollywood, but you may recognize him. He's frequently on TV where he shares his financial insights. After he speaks, if you haven't had enough of him, tomorrow he will be on CNBC at 1 p.m. Giving a presentation there. Bill's also a prolific writer. He frequently weekly writes for Forbes magazine and on topics such as wealth management, investments, and is a big fan of Warren Buffett's Berkshire Hathaway holdings. So frequent speaker and writer on those. He didn't authorize me to say this, but in his spare time, Bill takes a lot of tennis lessons, so one day he can maybe beat me, but that's yet to happen. So without further ado, Bill Stone.
Well, thanks for having me. It's good to be, I feel like it's good to be back on the speaking circuit because I feel like it officially ends COVID. I know I don't want to jinx anything, but that's what I'm going with anyway. So my plan today, if hopefully this comes up there. All right. Oh, there we go. All right. Is the kind of spend time talking about where we've been, because I brought up COVID partly because it really still shows up in a lot of the economic activity, and frankly, when I'm looking at companies, their earnings or lack thereof, depending on how it is. But let me just jump into it because I want to keep us on trend here. So this is a short kind of look at the blue is jobs in the United States, and the red is economic activity, real GDP, which is really just economic activity stripping out inflation, so after inflation is taken out of it. So to give you an idea on where we are right now, our economic activity in the United States is about 5% above where we were prior to the pandemic. So we've surpassed where we were and are, knock on wood, continuing to grow. That's my assumption for where we'll be when they finally report fourth quarter numbers. On the job side, it's kind of interesting because we're actually only a little over 1% above the pre-pandemic peak for jobs. So economic activity has grown much more than the amount of jobs. Now you may notice it from the service places and et cetera, but there's a reason for that. That has also led to having corporate earnings, so I'm going to say corporate earnings going forward. I look at the earnings of the S&P 500 overall are, believe it or not, about 35% above where they were pre-pandemic. So it's not shown on here, but that's kind of an amazing thing. So if you wonder why stocks are 15% above, even now 15% above where they were pre-pandemic, that's why. Because in the long run, what all really matters for stocks is earnings. So in the long run, they come together and stock prices move up with earnings. In the short run, they do whatever they want. But anyway, let's go on to what kind of, what's the important things to think about for the year. So really the big thing is inflation, okay? So in mid-2022, we peaked at over 9% year-over-year inflation numbers. As you can see, this is a long-term trend, or a long-term chart we haven't seen since I was a little kid. And I was hoping that we'd never see them again, but there they are. We did get better inflation numbers this morning, so inflation came down to 6.5% year-over-year. That's still obviously too high because we really target something around 2%. The economy can function on higher than that, but 6.5 is still way too high. I would say the more troubling part of it is we watch this kind of, that black number there is what we call sticky inflation. This is, we use the Atlanta Fed produces one, but essentially what you think about is what sticks around, right? Service prices, so you rarely see the cost of services go down even when things, you know, kind of slow down. They don't tend to, like, you know, you see commodities move very quickly one way or the other, but things like services, things like rents, they tend not to actually go negative. So that means they're slower to kind of ease back down the trend. Those are still running abnormally high. So if there's anything to worry about, and that's certainly what you're seeing the Fed worry about, that would be it. So what did that cause to happen? So that really caused the Federal Reserve, which controls only short-term interest rates in the country, but that's a very powerful tool. So that's, you see that, the red line there, you can see how fast this year they took short-term interest rates higher. So they moved short-term interest rates higher by 4.25% in a year. So that is very quick. The other thing you saw is 2-year Treasury yields moved significantly higher. I won't focus on it, but you know, they went along with them. They typically do move along with short-term interest rates that the Fed controls. 10-year Treasury yields, again, also higher, which, you know, again, all kind of weighed on what went on in the markets. So let's jump a little bit to where we're going, or where I think we're going, I guess I have to say, since now I'm in the soothsayer category. Let's see. Yeah, future is bleak. Let's see if, well, I'm going to keep talking while that's there. So, really the thing I watch, there we go, all right, I like it. And you don't really have to, that chart looks a little complicated, but the biggest thing and the most accurate way to forecast recession, better than any one economist out there, which is a low bar, but anyway, is really what we call yield curve inversions. And like everything in finance, we make it sound more complicated than it really is. And all it really comes down to is there's a bunch of different ones we can watch. People look at the 10-year yield versus the 2-year yield, and really what it is, it gives a signal when the 2-year yield is higher than the 10-year yield, most likely a recession's coming. The other one that I watch more that is tended to be more accurate is actually, this is where it gets interesting. So the 3-month yield, so we can pretty much have securities to do everything, right? So you can actually bet on where the 3-year yield will be, or 3-month yield will be in the future. So it's the 3-month yield 18 months in the future, when it is below what the 3-month yield is now. That has been a very strong signal that there will be a recession coming in a fairly short order. So it's typically, you know, it's hard to time these things it's been between 2 to 18 months before you've ended up in a recession. So that happened in late 2022, so which is why I expect that we will have a recession sometime here in 2023, probably, I would argue, late, or second half sometime of 2023. That's kind of what I'm showing here. The normal, or as I said, median is about 12 months ahead. It's happened, we've gotten going in a recession as close as 2 months after that inversion, or as long as 18 months after. There has been one instance where it predicted a recession that never came. So it's possible I'm wrong. But I like to go with the odds. But I'm hopeful that maybe I am wrong. I'll be happy if you'll invite me back next year to be wrong on that item, but I think it's worth thinking about. I would say I'm not alone in my prediction. So this is from Bloomberg has an economics team, and they build a model to predict recession, and they have 100% chance of recession according to their models out 12, 18, and 24 months, that there'll be one within those periods. So you know, I'm not exactly out on a limb here in my thoughts on what happens. I'm gonna skip that. We can talk about it later. So when I think about where we are in the economy now, I always say there's something for everyone. So no matter what view you want to have on the economy, you could pretty much come up with one, okay? So I'm going to start with the better news, which is the labor market. So unemployment rate has fallen to 3.5%, which is historically one of the lowest unemployment rates we ever see. You really only probably 4 other times that since we've been keeping track of it, you've had numbers that low or lower. So that'll show you how strong it really is, and there's really no sign of recession here. So as I'm giving my fearless forecast, there's no sign of it. I would say the only sign of it is that when you look and you see these those light lines there going across our what we call recession line. So that's just telling you where the historical recessions were. You can see pretty much when it always gets to a really low level, eventually a recession does follow. And that's really because recessions usually happen for 2 reasons. So one is an economy overheats, or one is there's some external shock. Think about oil prices going extremely high and that chokes off an economy. That's kind of the two ways to think about it. I think about overheating. Economies usually overheat when you have not enough workers to deal with the jobs, and the wages go up, and it ends up happening, so which might sound a little familiar to what we're seeing now. So that's a little bit of there. Again, on the good news front is I track how much cash is out in the system, and this is bank deposits and also money market deposits for people. And you can see, I mean, yes, it's off the peaks post-COVID, and you kind of see that money pumped into the system during the pandemic, and it really is not far off. So you have to argue, and there's a bunch of other stats too, but I think this is the easiest one to talk about. Households as a whole, and again, not every household, households as a whole are in very good shape. So again, most people are employed that want to be employed, and there's a lot of cash. So that's good news, right? I mean, that's all good. Now I'll get less good here. So I talked about the Fed raising interest rates at a historically very rapid clip. So there are parts of the economy that are very impacted quickly by that. One of them is the housing industry. So you see here, you've got, this is existing home sales versus mortgage rates. So you had mortgage rates go from sub 3% in 2020, mid-2021 to now, somewhere south of 7%, but that's a big move. And when you calculate the monthly payment on that, it is a massive change. So that helped to send us from existing home sales of these are all annualized numbers, of 6.7 million in January 21 to about 4 million at the last report in November. So, just a plunge there. And frankly, that's what the Fed was trying to do, because they're trying to slow down things to crimp inflation, and that typically there's no easy way to do that, unfortunately. There's a price to pay for everything. I'll just real quickly, it's interesting, so we track housing affordability, and you can see it was actually okay in 2021 because those mortgage rates were so low, and it's plunged to levels that we haven't seen since, if you've been around long enough, the housing bubble. Now, I don't expect the same outcome, by the way, that we saw during the housing bubble, but it just shows you the pressure on that industry and that part of the economy is certainly suffering. So that's why I said you could pick what you like to talk about what's good and bad out in the markets or out in the economy. Let's move to the markets real quickly. Last year, not a good one. I kind of break things up into different factors and different things that move. So the big picture is, you saw just the S&P 500 was down quite a bit. What got hurt the worst was down at the bottom here, growth companies, which is really, the way they're defined is high earnings growth, or high estimated earnings growth, and high sales growth, revenue growth. Those were extremely popular during COVID. It kind of generally, what people go hand in hand with is a lot of technology stocks. Not all growth stocks are technology stocks, but most technology stocks are growth stocks. Also, a lot of stuff that gets put in there is maybe companies without any earnings, but high optimism that someday they'll have very strong earnings growth. Well, people lost their optimism and appetite for those kind of companies, and they just got slaughtered last year. A lot of that, I would say, is a function of interest rates. So I kind of took the other side of the coin, which is value stocks, which is not looking at growth, but looking at what you're paying for the company. And you can see that's the blue line there. The other line is interest rates. And you see this is value versus growth stocks. So value stocks just outperformed almost in line with what, as interest rates were going up. And it makes sense. I mean, when we look at companies, you're going to discount back using an interest rate, what cash flows they're expecting. So when interest rates go up, if you're getting your cash back quicker or earlier, that's worth more than if it's some growth stock and it's not expected to start earning money until way out. That's the change that, well, frankly, mathematically should happen. It's just not very pleasant for those invested there. The other part I'll mention is, we saw at one point, so it was really in October of 2022, the S&P 500 was 25% off its high. This is how much the market tends to be down during recessions. So I think the optimism for me, despite all this things of talking about recession coming, is that typically stocks are down about 24% around recessions. Now, it sometimes gets way worse, sometimes it's actually way better than that. So we have priced in quite a bit of bad news, which is good news on that sense. I'd say the other part about it that's good is the market moves before economic activity gets better. So typically the market starts moving up 5 months before the end of a recession, and it moves up very quickly. So you can see it usually is up about 28% before the recession's ever over. So I always say if I give you any sort of advice, it's trying to time based on what economic activity is going on right now is a bad idea. So honestly, it's usually a bad idea, or at least a less good idea, to buy stocks when economic activity is going gangbusters, because unfortunately it's usually, I talk about the overheating, it's probably going to overheat at some point. The opposite is true, is that actually when you look at it, the best time to buy is actually when the economic data is the worst, believe it or not. So the timing, that's borderline impossible. If there's anything I can also leave you with is trying to time it, not really helpful. So I just try and explain things so people get less nervous about it, and that's mostly what my job is. So I just gave away the secrets. Let's see if I come back here. Oh, right arrow, good. All right, well, I'm going to keep going here. Oh, there we go. Now I'm going to go. I did it 2 times.
It's on this screen.
Okay. I was looking the wrong way here. There we go. Sorry. All right, I'm going to keep going. So I think part of what I was saying is, and I started to say it and I showed, is that really it's all about long term and, riding through these periods. So what I had up there is a, go back, hopefully. I'm probably jinxing myself by going back. I must hate that slide. I'm maybe that's trying to tell me something. All right, I'm gonna maybe go past that. All right. Okay. Yeah, go back a slide if you could. Sorry. If it doesn't like that one, then but what the slide is going to show you is that despite all those travails, and I usually look at even a longer period, but I really just looked at over 5 years. If you've been, and you think about all the bad things that happen, COVID essentially, I mean, that's bad enough for me, I don't know about anyone else. But you think about that going on, you would have, if you thought about it in that terms and all we went through, even after the sell-off last year, you would have turned $100 into $157 over that period, which is pretty amazing. I mean, and that to me is, like I said, it doesn't work over every 5-year period, but certainly over almost every 10-year period, you're going to make money. And I think that even to me, the more important thing in terms of long-term investing is that what you really care about is retaining and growing your purchasing power, hopefully. And so after inflation, that's where stocks shine over the long run. So that's why I put up here. So annualized, that would have been 9.4% in nominal terms, but after inflation, and you think about it, we had some pretty significant inflation here, you'd still be annualized 5.4%. I mean, growing your real net worth or purchasing power by 5.4% is amazing, frankly. And you look at some of the alternatives, after inflation, you would have lost money at a 3.6% rate in bonds, and you would have lost money at a 2.5% annualized rate in cash. Again, it won't always be that way, but I do think it's worth, again, in the long run, what you're trying to accomplish is there. Stocks are the place to be, even despite all the things to be afraid of. Oh, I screwed you up. I should have said next one. So what I'm going to talk about is what to do about all this. So I kind of left you with all that. So I said there's going to be, I highly believe there'll be a recession. I hope I'm wrong. But either way, you're not going to be hurt by me saying prepare for a recession. So what does that mean? I think you make sure your household finances are in order. You've got enough cash to ride through a recession. If you think your job might be in jeopardy, which unfortunately probably all of ours are, at the end of the day, it's just the way life is these days. So, make sure you got enough set aside there. So as much as I'm positive about investing, make sure you, first of all, I always say you got to survive through it to get to the other side to keep making money. So make sure you're in a good place there. I'd say in terms of stocks, what you want to invest in is really focus on quality and valuation. So again, they got to survive through the downturn to get to the other side to continue making money. Also, I'd argue real high quality stocks tend to actually get stronger during recessions because their competitors get weaker or frankly go out of business. So when I give my little picks at the end here, I got to move quickly. That's what I'm focused on. Also, I tell you, you're in good company if you focus on valuation quality, because frankly, if you disaggregate the way that Warren Buffett got rich, he actually did it by investing in quality stocks at a reasonable price. Also, he's a genius, but try that too if you got it, but can't eat everything. So anyway, it's an easy recipe. It's one of those ones where I particularly focus on it around recession times, but honestly, it's a good strategy all the time, which is always a nice thing. So let me do my stock picks. You can hold me to it next year if you bring me back, so that'll be a good reason. So first one, Amazon. Kind of everyone knows Amazon, but the interesting part is, again, kind of going back to the pandemic, it has given up half, it's gone down by roughly half from its high, say, around the pandemic. And really, because everyone got so excited because they saw, obviously, online sales went ballistic because, of course, you weren't going to go out and get stuff, all those things. But I will mention, Amazon is really more than just kind of the e-commerce that everyone thinks about. They also have this cloud business that if your company's not already on it, I think most companies, we have our stuff on the cloud. Everybody's moving to it, so it is a phenomenal growth business. There's really, let's call it 4 primary companies in that business. So, when there's less competitors of scale like that, it usually turns out to be a good business over the long term. I'd also say advertising. That is part of their business. So it is a very strong business. Weirdly enough, they make more money off of, or better margins off of other things than they do off of e-commerce. That kind of just makes everything else work. Valuation looks expensive when you look at it, if you kind of look at PEs and such. But the issue is, I think they do it right, which is they're investing in the business to earn money, and I think more money in the future to dominate spaces. If they wanted to show more earnings, they frankly could. So you gotta adjust their valuation a little bit. I'd say the last thing, again, when we're talking about recession, super strong balance sheet. You do not have to keep awake at night about them going out of business during a recession. It's just not gonna happen. And if you ask me, are they going to be stronger coming out of the recession? I will bet you money they would be if we have one, because a lot of, or at least some subset of retail stores won't make it. So they'll have less competitors coming out than they had going in. Not a pleasant thing, but it is what it is, and so you try and take advantage of that. So I think that's a good one. Second one is Anheuser-Busch InBev. That one trades under the symbol BUD, Bud. So key part of it is stock's down almost 40% from its pre-pandemic peak. Part of it was COVID really hit that company because you can't have outside events, all those things hit it. There was also other things, which I love talking about, but I don't have time now. Hard seltzer, all sorts of things that I get into looking at. It's the largest brewer in the world. Brewing, and that matters, by the way, because brewing is a scale business. They get the cheapest prices, they've got the distribution network, they can dominate. I'd also say they have 4 particularly global beer brands. You may or may not like them, but the fact is everyone in the world wants to drink them, and that's Budweiser, I said, sorry, 3 of them, Budweiser, Corona, and Stella Artois. The other part I think is interesting is they get 2/3 of their earnings from Latin America and Asia. So, most people probably think of it as Budweiser here in the US, but they really are part in growth parts of the world. And they have dominant position in Latin America and Africa. I mean, dominant. So it's to me super interesting. They put too much debt on the, I don't say too much, they put a lot of debt on the balance sheet to buy SAB Miller because they've kind of grown this over time. They're in the process of selling that down paying down that debt. Once they pay down that debt, that cash should accrue to shareholders. So remember I said earnings coming to shareholders is what matters on stock prices. So that to me is what gets it going. Lastly, I'll leave you with, which may not be surprising, is alcohol consumption does not fall in recessions. I will warn you that alcohol, people do trade down, right? So I'll probably be drinking Busch Light. But if that, and I will warn you, if that happens, you probably ought to run for the hills. But we'll see. I hope that won't be forced to do that. So we shall see. So with that, I will I'm happy. I'll do some questions. If you want to see more of the stuff like Anuj was saying that I write, I have some stuff, and there's no ads on there. It's up on our website under Wealth Insights. I've got a bunch, and actually even Anuj has some stuff up there. You don't want to listen to that, but and then Forbes too. I have all my stuff out there, so happy to take questions.
Okay, Rotarians, begin making your way over to the microphone, and the President Walt sent me a text and said, please ask all the Rotarians to pay attention to the guidelines on the screen. Let's see how we do. No speeches, just questions. All right, you're up. Introduce yourself and ask your question.
Thank you.
He said not to take the mic apart.
Thank you, Barbara. That's always good to know. Thank you, Bill. Great presentation. Dan Maloney, director at Louisville Zoo. By the way, there's a bald eagle out on the tree right there, and not one of our vulture species. So that's probably a good sign for your presentation. Just a quick question. What about this latest wave in China? This variant for COVID. Do you see this as being a problem going forward?
Well, hopefully I don't jinx myself, but I think the world is just, particularly the U.S., I think it's hard to speak for other countries, has just decided to go forward, I think we've all seen it, it always worries me, obviously, because you worry it's a vicious enough, maybe variant eventually, that we can't kind of go forward or whatever, it gets through our immunity, but I think, generally speaking, so I think that is what will happen is we'll frankly ignore it or live with it or whatever you want to say. But I actually weekly watch the infections and death rates, unfortunately, here in the U.S. still. And then I also particularly watch TSA gate checks or how many people go through the TSA. So I'm giving you my secret of, I watch that because as long as people are still traveling, I figure they're not really scared. So you may hear people talking about and saying they're worried, but if you're traveling, you're not worried.
I was thinking more about the economic impact
of
China being not so much coming this way.
Oh, yeah. So, I think China's trying to reopen, and it's hard because you can't trust any data they put out of theirs. So it makes it even more difficult. I would say I'm more optimistic that they're opening, I'll say for good, despite what happens, because the people, frankly revolted and the government folded. Because the one thing about the Chinese government, it's probably true of all governments, right, is their incentive or what they want to do is stay in power no matter what. That's just the way I look. If you ask me to look at China, that's the way I look at China. Probably the way I look at all countries, frankly, but it's more extreme there, right? Because you've got, a dictatorship and a real control from one person now, really. But anyway, so I think they'll stay open. If that happens, that's actually good for the economy. Interesting thing is, I'll just side is, the U.S. economy is big enough on its own. We actually can either stay out of recession or go into recession on our own. So most other countries are kind of more hostage to other big countries. While it'll be a headwind or tailwind for us, it doesn't kind of change the big picture for us. So that's why I don't worry as much. I mean, we're actually happy, obviously, if more people are doing better in more countries because it's a tailwind, but even if they aren't, we're a big enough on our own to drive things.
Bill, I'm Tom Bonert, and back in summer of '21, when we were all happy and saying, interest rates look like they're going to stay low, inflation, no problem. A friend of mine who's a contractor and builder said, we've got inflation, you're just not accepting it. And she was referring to the skyrocketing prices of lumber already. So my question is, there was inflation, since there was inflation, before we really either accepted or recognized it, what is your impression about the Fed? Should the Fed have acted sooner? Would something have been a little different if the Fed did act sooner? My second question, if you follow currencies, I'm curious because as the Standard & Poor's has risen in the last quarter, the dollar has declined. I'm curious what your impression is for the future of the dollar. Thank you.
Well, I blanked out what the first question was. Inflation, sorry, yeah, that's sorry. So I was so zoned in on the dollar. So inflation, certainly the Fed should have acted quicker. I'm not sure that it changes things that much in the sense that we don't. You saw the money, the amount of money in the country just skyrocket. We did unprecedented things, and that's hard to say after what we did during the global financial crisis after the housing bubble. So we decided, it didn't do anything bad to us then, we're really going to go for it. So like I said, I'm not clear. I do kind of subscribe to there's a price to be paid, there's no free lunch. So you can argue it was a good move because we kept ourselves, again, you can argue a lot of mistakes were made, but in the end, given what was decided, maybe it was the best of a lot of bad alternatives. And I'd say the same thing about them raising rates now. It's the best of a lot of bad alternatives because you do not want inflation to get out of control. Like you just can't let that happen. So pain in the short run, to snuff it out is unfortunately, again, maybe the best of, again, bad outcomes. So on the dollar, what you're really seeing there is some part of that is the dollar goes up a lot of times when people are scared, okay? So it's the safe haven. You may think, we're a friggin' mess. These guys spend like drunken sailors, blah, 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 but we're better than everyone else. So that's the good news of the day. So you tend to see dollar flow or money flow from all over the world into the dollar when people get nervous. When people get nervous, S&P goes down. That's some part of it. Also, the thought prior to that was the Fed was going to keep hiking even more than we're expecting now. We're currently only expecting 2 more quarter-of-a-point hikes, one in February here and one in March. It was more expected before. That tends to determine or help determine which way the dollar, whether it's getting stronger. More hikes usually means stronger dollar. So that's the quick and dirty, usually.
Hey, Neville Blakemore. So it's my understanding that one of the contributing factors to the really, really, really low unemployment number, is that a lot of people, retirement age, just left the workforce. They're done, they're out. And hence that big switch. And we almost really sort of need a recession, not to force individuals back into the workforce, but to basically take off some of the pressure. Would you agree with that assessment that we almost really sort of, we don't need a great recession, but we do need some sort of recession so that the people participating in the labor force actually goes up?
Yeah, I'm going to hope not need, but you're right. I mean, so we had a lot of people leave the labor force. You saw the older cohort finally decide, we're just guessing, we don't really know on the whole, but probably, hey, I'm sick of this, I got to deal with COVID, all that, I'm done, I'm just going to throw it in now. And so we always expected that to happen, but also, they haven't come back, and maybe they would if we got a recession again. If you have less demand, you don't have it. I guess if there's ever maybe something hopeful, we are seeing a lot of companies, I'm watching it, is for better or worse, it's probably good in the long run, painful perhaps in the short run, though good for what we're doing now is a lot more automation. So, we've got we own some fast food restaurant investments, and so you've got them automating drive-throughs, so you may be talking to a robot when you're going through a drive-through. They've got more, food being prepared by robots, things like that you always, or that you'd still think would be all humans, but frankly, it's moving in that direction because eventually labor gets expensive enough and it's worth it to buy the machines. And we don't have enough people that want to do those jobs on top of it. So at the moment, it's a win-win. It's a little scary for the long run. If people need jobs and they don't have the skills, that's a problem because that was an entryway, but that's something that I will not be tackling because I'm not a politician, but I'll leave that to other people. I can find the problems, I just can't necessarily fix it.
Okay, so I thought you were teeing all that up for me, but we had no conversation about what was going to happen next. I just got to ask you, when you mentioned that the older cohort said, I'm finished with this and I'm staying home, why did you look at me?
I didn't. It was not on purpose.
Okay, all right.
You're not old to me, I don't know.
Oh, well, this guy. All right, well, we have a few minutes left. I'm going to make a presentation to you, but I don't mind sharing with everybody that, as you know, it's day 9, I think, on my new job, Jim, as Deputy Mayor of Louisville. And when I agreed to serve in this capacity, I had one question, y'all. I kid you not. I asked Mayor Greenberg, I said, does this mean I stay on Medicare or go off of Medicare? So yeah, I'm up there. I turned 66 on this coming Sunday, and I love every minute. Bill, when you advise your clients in the future about being the older cohort, not staying in the workforce, and being part of the action that moves these numbers and these analysis back and forth, just ask them to rewire, stay in the workforce, and stay engaged, or do great things with your money. All right, here's what we're going to do. We got a very special, there are like 5 phones up here. Okay, we have a very special presentation to make to you. Our Rotary Club is the 14th largest club in the world. There are 47,000 clubs. Everybody go, ooh-ah. Ooh-ah. We're very proud of that. All right. And so we have developed an initiative here in our club in recent years called the West Louisville Housing Initiative, because we decided, with all of the brain power and the knowledge and the diverse experiences that we have in this very club, that we could raise $5 million, not Rotary International, this club. And that money would be used to help, at a minimum, 63 first-time homeowners in West Louisville. And we are making a $500 contribution to that initiative in your name. This is a fabulous 80-pound card stock suitable for framing. All right, thank you. Oh, that's really funny. He just picked up my phone. So that is the hot government phone. No, I know. You're so easy. Oh, okay, let's see here. No, I have a selfie that I just took of Mike Richardson and me. We sent that to President Walt, because Walt sent me a text at 1 minute to 12, and he said, have you arrived yet? You got to start the meeting. All right, so here we go. Fellow Rotarians, we do have 5 minutes left. I'm not going to use all that time, but I do want to give you some of Walt's words of wisdom, all right? And then we're going to have our drawing. Of course we are. And so, Bill, stand right back up, buddy. Come over, draw a number out, and we're going to see. I did that to pique the audience's interest. They can't wait. This winning number, ladies and gentlemen, I'll let you read it, wins a free ticket to the February 2nd Rotary meeting of Mayor Greenberg's first State of the City address. Read that number, Bill.
216684. We'll see if I bring it. That would be awesome.
Is it 684?
684, yeah. Yeah, not bad.
Okay. All right. Bill, reach your long arm over there, the long arm of the law, and grab another ticket out of there. We're going to read tickets till somebody wins this. Okay, last 3 numbers.
Yeah. 675.
No one is left. They don't want us to know they're going to that. Okay. All right, draw another. Hey, and this meeting is Rotary's going to host it, and we're hosting it at the Americana Center. That's really cool. Okay, last 3 numbers.
721.
Okay. No, is it Tom? Is it, okay, Tom, okay, thank goodness, thank you. Okay, Bill, you did a fine job with that. All right, Walt's words of wisdom. Okay, so since we mentioned and we heard, do we have something to hand to Tom, Deline? No, okay. That was a trick, Tom. Okay. All right, so we heard from Warren Buffett a couple times. His name was mentioned, and I just want you to know Walt's words of wisdom this week, you all. Here's what Warren Buffett had to say. He texted me while you were talking, Bill. He said, just make sure after Bill talks, tell everybody the secret to getting rich on Wall Street is you got to try to be greedy when others are fearful, and you try to be fearful when others are greedy. Okay, there you go. Then I needed to check with the circus, P.T. Barnum, because sometimes a random walk down Wall Street kind of gets your attention. P.T. Barnum said, money is a terrible master, but an excellent servant. And J.P. Getty said, my formula for success is to rise early, work late, and strike oil. I don't think I heard you talk about oil today. And lastly, fellow Rotarians, I thought I'd share with you, you said something when you were given the 3 last points at the very end of your presentation. It reminded me of something that my father said, but you said it very differently. You said, get your house in order, keep your house in order, and then do these other things. When I was in elementary school, my dad used to give me 10 cents a week, and he had a formal ledger book that he would write that little decimal 10 in a Pentel 0.5 pencil. You all know what I'm talking about? And every week that 10 cent would add up, and then I got 25 cents when I went into junior high school every week. And one day I overheard Dad say to somebody, well, of course money can buy happiness. That infuriated me. I went running into the dining room and I said, Dad, how can money buy happiness? And he said, Bill, if you have enough money to buy food, clothing, and shelter for you and your family or those you love, you're going to be a lot happier than anybody who doesn't. And so, Jim Allen, you know the rest of the story. That's how I got to where I am, and I appreciate you and your whole team. All right, fellow Rotarians, those guests that are in the house today, make your way over there to the table to my left. I still don't see anybody. Oh, Craig Sherman. We sent an all points bulletin out for you. Make your way over here. Craig will give you a quick what is Rotary. And then also, our next university session is getting ready to start, and it will start momentarily over here as well. And Deline, our famous, fabulous executive director, do you need anything else? You're good. Oh my goodness. Wait. Hold on. Okay, we are adjourned. Thank you all. Have a great week.